Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Monday, it's October 23rd, and it's about 7:53 in the morning. The market's not going to gear up to open for another hour and 37 minutes if my math skills are still correct. I hope everybody had a good weekend. I was out. I was playing hooky on Friday. I went Thursday night to Animal Kingdom with Rachel and my wife Natalia, and we had a great time. I've never been to Animal Kingdom before, but I got back Saturday morning, and I've been analyzing the market since. I've been actually doing a lot of work over this weekend, a lot of fun work, but we've got a lot to talk about today. By the way, before I get too deep into this, folks, I've been giving some red-hot trades on my Telegram channel. They've been free. It's not going to stay that way for much longer, maybe another couple of weeks. We've been hitting over 90% win rate. Yes, over 90% win rate. You could look at the Telegram channel and see for yourself. I highly recommend you get in on it before I close those day trades down. Now, let's talk about, and I'll be updating you today as usual, so sign up for Telegram. If you don't know how to find it, go to rogerscott.com/Telegram or click the link in the video in the YouTube channel. If you don't know how to get to the YouTube channel, you may be watching this on the Roger Scott website. Go to YouTube and then go to Roger-Scott and the channel will pop up. Like that channel, subscribe to that channel, and join me live in my VIP room at noon today. All the links are below the video in the YouTube channel. Trust me, you want to get in on it while it's red hot. So we have a lot of issues being thrown at us this week. As you can see here, the Dow is down about 135 points, a little bit beyond random. Anything over 100, 110 is beyond random. It used to be about 80, 90, but now with the value at 33,000, we got to give the Dow a little more breathing room. Nasdaq's down over 50. That would be equivalent of over 100 points on the Dow, which means this is beyond random, and the S&P is meeting us in between. Now, what are some things we're dealing with beyond the war in the Middle East, right? Like, that's not enough. Well, let me show you. And I'll be sending you this sheet, earnings October 23rd through 27th. This is right here, a sheet that shows you all the expected moves of all the biggest stocks that have earnings this week. And I'll send this in my Telegram channel. You may even get it via email. But you could see that there's nothing really big today except the market trading below the 200-day moving average, which I'll get to in a second. But you could see tomorrow, ADM, Dow, GE, General Motors, Google, Halliburton. They're coming at us, and they're coming at us fast. And remember, if Google gets hit, it means other FANG stocks may get hit too. So you got to look at related stocks. But earnings are going to be wide open. On Wednesday, you've got IBM, Meta on Wednesday. On Thursday, you've got Amazon. So you've got a lot of FANG stocks coming out with earnings. And on top of the FANG stocks, you've got all the other stocks. So this is what's expected in terms of the movement after earnings are released, in case you want to sell options and you think that Google's going to move more than 5.7%. It doesn't tell you which way. And here are the actual numbers for all the earnings, and I highlighted all of this. And I'll send this to you on Telegram shortly after I'm done with this video. But you can have this, and this will give you a good guide of what's expected. This is what's baked into the price of the stock. This is the stock, and the big ones I've highlighted here, and I've also given you the implied volatility for all the major stocks. You're welcome. So I'm taking good care of my guys. Now, economic calendar. Personal consumption expenditures and spendings is going to be the big report this week. But we also have the GDP. We'll see if we're making strides. We've got new home sales. Watch those home stocks, home ETFs. They're not doing well right now. And you've got PMI tomorrow. Today, the market will kind of stand on its own in anticipation of earnings. Now, let me talk a little bit about the fundamentals and our tailwind, and then I'll get into the technicals because there's a lot to talk about on technicals. So right now we are in the end of October. We have seasonally weakness between end of September through October, but that weakness usually ends right around midweek. And we start going strong. We start going bullish between now and the end of the year. Now, does that mean we're going to have a year-end rally, a big rally? Is this a shakeout? It's hard to say right now because we still have to see earnings for these large-cap stocks. Things are not looking great, and I'm not expecting an end-of-year rally. And we haven't had much of a year-end rally in the last several years. They've been very wonky, these end-of-year rallies. But again, seasonally, The downside that happens between September and October is coming to an end, and seasonally we should be approaching an upper end of the range. We should be getting some tailwind from the stock market in terms of seasonality. The problem is countries like China, Japan, Europe, they're not giving us any tailwind. And if China's not giving us tailwind, and if retail sales are bad, I don't know if we're going to have that year-end rally. But as far as seasonality is concerned, we should be starting to move back to the upside over the next few sessions. Just wanted to kind of give you heads up. And again, I'll talk about technicals in a bit, but seasonally, the weakness is almost behind us, and we should be starting to see some strength, and I'm looking forward to that. We've been trading to the short side. I mean, we've been doing really well, but we've been trading to the short side last few weeks on the day trades in the Telegram, and they've been doing really well. It'd be nice to switch and start trading to the long side, right? So 10-year yield hits 5% for the first time since 2007. And you could see that right here. I mean, it's clear as day. That's putting a lot of pressure on the stock market, and that also takes away from that end-of-year rally. Look at that. I mean, look at that. That's yield. The bond market is doing the job for the Fed. All the Fed has to do is just sit back and do doo-doo-doo-doo-doo-doo and wait, because the bond market's the bond market's the bad guy now, because the bond market is making yield higher, not the Fed. But in essence, the market's doing what the Fed wanted to do. So the best thing for the Fed to do is just stay out of the market's way right now and take credit for it, which obviously they always do. Nasdaq is at so again, anything that's interest rate sensitive, like consumer staples, real estate, financials, tech, it's going to be feeling that pressure, which is one of the reasons why we're trading below the 200-day moving average. The Nasdaq is at a 2-week low. This is not good, although it is holding a lot better than the blue chips. It's at a 2-week low. Mester said Friday that U.S. Central Bank is approaching the conclusion of its aggressive tightening. Of course, the bond market's doing all the work for you, but signaled she favors raising rates one more time this year based on how the economy evolves. Basically, she has no idea what's going to happen. She's just playing wait and see. She says, regardless of the decision made at our next meeting, if the economy evolves as anticipated, in my view, we are likely near or at a holding point on the fund rate. Also, Harker stated the Federal Reserve should hold interest rates steady even in the face of slightly faster than expected economic growth. Right, because the bond market's doing all the work for you, rascals. We are at the point where we can hold rates where they are. Yeah, because they don't know what's going to happen, and they've raised them enough. It's a wait and see game right now. There's a 98% chance that there's not going to be any rate hikes this month. And as far as next month, not in October, November. And there's a 24% chance that there will be an interest rate hike in December. I actually think they're going to be raising in January. I think they want to let this year be and see what happens. So earnings, the big stocks. And remember, markets can't move without these big stocks. So we got to watch these very carefully. And if they rally this week, and I don't know if they will, but if they rally this week, the market will rally with them. The mega cap, Microsoft, Google, Coke, Meta, Amazon. You know how much market cap you have right here? Whew, you probably have about 20% of the stock market right here, maybe 25% of the stock market right here. I'm not joking, I'm serious. U.S. core personal consumption expenditures, that's what's going to be coming out this week. That's what the Fed is looking at. Investors closely monitor Middle East for more drama, which is not going away. Hamas released 2 hostages, 8 starting to trickle. I mean, it's a very unfortunate scenario for everybody. Kids, children, women dying. Nobody wins here. There's no winners. That's what they seem to not understand. Nobody wins here. Europe is down again. They're not doing all great. The tension in the Middle East, remember, they're much closer to the Middle East, is impacting them. They're looking at earnings in the U.S. China closed lower, hitting almost a 1-year low. No tailwind from China. Over troubled property sector. Sentiment was further dampened by announcement of a series of investigations into Foxconn. Ugh. Tech stocks led the decline on Monday, and Japan closed lower again. We're not getting tailwind from anyone, China, Europe, or Japan. Very, very bad. Energy industrial stocks fell on Monday. Healthcare outperformed. Don't know what that's about. Industrial and healthcare usually move fairly aligned, but what do I know? Again, Middle East tension is the big deal, and look at all the earnings you got today. No major names. The major names come out tomorrow, but you could still see today. Look at that. You got Calix, Cleveland Cliffs, Crane, MedPace, Packaging Company, WRB, substantial stocks, but obviously not Meta or Alphabet. That's tomorrow. So you're going to have to keep an eye on the sectors. Let's talk technicals. This is where we have to have a tough conversation. The S&P is now trading on high volume, by the way. Broke through the 100-day, the 50-day, the major support as we expected. Remember I told you this downside channel will more likely hold? It held. And we broke right here, and now the question is, are we going to consistently stay below the 200-day moving average, which puts us in bear market territory or not? Well, I'm going to tell you something. There's a really good level of support right here that we just broke. The sentiment likes the fact that the market will consolidate, at least today, not go really hard. But I'm telling you right now, if earnings are crap, this will go lower. This will go lower. Now, looking at this channel, let me just say this. We have all the way to down here for this channel break, all the way here. There it is. We have all the way till down here till the 412. But to me, it seems like we're going to be going down there and trying to trigger some sell stop and some panic selling. That's what the market does best. Looking at the QQQ, and I'll look at individual sectors. We're not as bad. We're still in a sort of a choppy, but with a down slope market. If we hold this level today, that's going to be a positive sign. If earnings are good on tech stocks tomorrow, it'll be a very positive sign. But we have to be very careful because this could be a big shakeout. If this is a big shakeout, in other words, if on the S&P, pay attention to what I'm saying. If this opens down and then starts coming back up into the 200-day moving average, we could start seeing some buying here. So we have to really give the market some time today to see where it wants to go. Keep your eye on the Nasdaq, keep your eye on the SPY. And as far as sectors are concerned, again, keep your eye on the first hour, whether we break this level at 350, 349.50 or not. It's going to be very important on the SPY and on the QQQ and on the SPY. The level 413 is going to be huge, but we're already trading below the 200-day moving average, so it's not looking pretty from where we're sitting right now. Looking at individual sectors, I wanted to give you a graphic look. It's depressing. Look at retail. Wants to come down. Look at energy. Doesn't look all that great. Look at consumer staples. Nothing is looking good. So it's kind of like trying to pick the strongest ETF from a bunch of weakness. Well, when we look at it on a numeric basis, not a graphic basis, you could see retail, energy, consumer staples, communication services. This is tech. This is very, very safe. This is energy, which has been rallying, and this is consumer discretionary, really. So to say that this is a one hell of a confusing market would be an understatement. Look at consumer discretionary and look at retail. Look at energy and look at utilities. I mean, look at technology and look at communication services. Meta, Google, that's communication services. That's tech. We're all over the place. Looking at it on a 3-week basis, communication, technology is still holding on, energy and healthcare. The point is, we are all over the place. This is imagine somebody putting these 19 sectors in a pot and doing this in a bag and just shaking them up. Everything is messed up right now. Everything is bearish, but my suggestion is to keep your eye on the Nasdaq 100 and the QQQ. Don't go sector specific right now because everything is on the line because we're below the 200-day moving average. So there's a lot of selling pressure coming in. The biggest question is this going to hold or are we going to start coming up to the 200-day? My feeling is we're going to start feeling out the trading and we're going to start rallying in the morning, and then we may catch some selling off guard. But be careful. Be very, very careful because if we go up, we're above the 200-day moving average. If we go down, we're in a very, very tight spot right now. Stay tuned to my Telegram channel. I'll be giving you updates all the time. RogerScott/Telegram. It'll give you full instructions. You download it on your computer and you sign up via your phone. It's really, really simple. Also, join my VIP room at noon. And remember, something very important, folks. Outside of Wall Street Circle, folks tend to believe that they can't benefit from a massive rally in AI stocks. But it couldn't be further from the truth. Today at 1 p.m. Eastern Time, Chuck Hughes and I are hosting a big reveal to show everyone exactly how it's possible to unlock hidden pockets of income on the most powerful AI stocks in the market. You don't want to miss out. And this doesn't just apply to AI stocks because AI stocks aren't doing all that great right now. This applies to all stocks in the stock market. And it's a way to trade without having to be amazingly precise on market direction, which is what you want right now. You don't want to be market timer right now when the S&P is right below the 200-day moving average for the first day. It can get really messy here. And we can go down and then start coming back up. Volatility is very pervasive right now, and we have no tailwind from earnings or Europe or Asia. So we could be right now looking for some really big doo-doo on high volume. And by the way, look at volume here. Look at how high the volume here is when we broke this in comparison. Notice highest volume on a breakdown. That's meaningful. That's a committed selling pressure. That's not random. So again, you want to stay tuned to what I have to tell you. We've been having a 90% plus win rate on our day trades in our Telegram room to the short side over the last 3 weeks, since the 10th of October, actually. Yeah, 2 weeks. So you don't want to miss out. Follow the link below, and I'll see you at noon, and I'll see you at 1 p.m. with Chuck. Bye, guys. All times are Eastern. Like our channel, subscribe to Telegram, and subscribe to our YouTube. Bye.